The US market has performed exceptionally well over the past decade. Furthermore, the US market is concentrated in just a handful of very successful tech-related companies, the Magnificent Seven, and has high valuations relative to the rest of the world. US outperformance may not continue, however, so in this video we'll consider a simple way to build a global stock portfolio with less allocation to the United States. Remember that nothing in this video should be considered financial advice. You should always do your own research. Here we can see a comparison of a US-only index, that's MSCI US, to an index which tracks all 22 other developed markets, excluding the US. So that's called ACWI, All Country World Index, ex-US, and also 24 emerging markets, and that's over the past 15 years. Both indices contain large and mid-cap stocks, but the ACWI without the US stocks and companies performs significantly worse over this time frame. For an investor looking to maximize the return on their pound, the US has been the land of promise and consistent bullish growth for the last couple of decades. But will it be the same story in the decades to come? One of the main factors causing this historical outperformance of the US stock markets is due to a small handful of companies called the Magnificent Seven, or MegaCap 8 via Yardeni research. The blue line you can see here is the proportion of the S&P 500's growth from the MegaCap 8 stocks. Red is the MegaCap 8 stocks market capitalization share of the S&P 500. These companies include Apple, Amazon, Alphabet or Google, Meta, Microsoft, Nvidia, Netflix and Tesla. They're from industries such as technology or communications. Large Silicon Valley tech giants such as Google, Apple, Meta and Nvidia have market capitalization values in the trillions, with immense market share and power. These companies dominate the growth of the S&P 500, with up to 65% of the US stock market's growth being from these 8 out of 500 companies in 2024. While this has boosted the US stock market, some people are questioning whether the buzz and excitement surrounding these companies, which are in the tech and AI industries, has grounding in both the fundamentals of the businesses and their long-term growth potential. With the recently high volatility and overvaluation, that means high price-to-earnings multiples of these companies, there is a risk to investors of a potential collapse in this Magnificent Seven bubble. With Yahoo Finance reporting recently that nearly 90% of fund managers believe that US stocks are overvalued, it's important to consider the possibility that that's true, and to reflect that within our own investment portfolios. But we should at the same time be careful not to miss out in the case of future continued outperformance of the US Magnificent Seven. The MSCI ACWI index, that's the All Country World Index, is a global index weighted by the relative sizes of each of the country's stock markets. We can see that the US makes up about 65% of the total market, with the next largest single country being Japan at about 5% and the UK at around 4%. With around 30% of the US stock market being made up of only 7 or 8 companies, and also note that the US only makes up 4.2% of the global population, there's a lack of regional and industry diversification. The graphs here display the proportion of the US stock market made up by the 10 largest companies in the US, with it rising upwards to 35% since 2015. This means that the other 490 companies in the S&P 500 make up the other 65%. This large market concentration has become more of a worry in the last decade. However, it has been a structural issue in the US for many decades, and you can see that in this graph with over 20% concentration ratios back in the 1980s. With recent events, such as the fall in Nvidia's stock due to the emergence of Chinese tech company DeepSeek, we can see how such a high concentration could lead to a more volatile portfolio. Looking at a longer time horizon, we can see that this US overweight has been a consistent theme, and this is throughout the 1900s. Between the 1980s to 2000s, there was a pullback, and that's because Japan took up some of the US's market share. But by the time we reached the early 2000s, that was over, and the US came back to the fore. And what's kind of interesting here is that the US seems to have had a boost in global market share in the decades following the World Wars. Because the US is the world's largest stock market, it naturally attracts the most criticism and close monitoring. And it's important to note that other countries also suffer from high concentration ratios. For example, we can see in Taiwan, one single company makes up 40% of the stock market, and this is Taiwan Semiconductor Manufacturing Company, or TSMC. And in fact, 10 out of the 12 largest equity markets have a higher ratio held by the top 10 companies than the US. At the very top, we see Switzerland having around 70% market value held by only 10 companies. And that does seem extremely high. Switzerland, however, is of course a very small country, and its market capitalization is small relative to other markets such as the US, Canada, China, India, or Korea. So how can we create a portfolio to balance the risk and reward present in the US market? Well, we can split the global stock market into 3 regions. So those would be the US, developed markets ex-US, and emerging markets. Fortunately, there are low-fee exchange-traded funds that give you exposure to all 3 of these markets. And if you want to dial down your US exposure, you simply buy less of the US fund, say. Maybe you'd go for 55% US and move the weight into the other 2 funds. This portfolio is made up of 65% US stocks, 25% developed markets ex-US, and that would include Japan and Europe, and 10% emerging markets. So that would include, for example, South America, Africa, Southern Asia, and so on. Its performance will closely match a global index such as MSCI All Country World Index. So really all we've done is we've taken the global index and carved it up into those regions. This chart allows us to see the relative performance of 4 different US weighted portfolios to the ACWI exchange traded fund. And that tracks the global MSCI ACWI index, and this is over the last 15 years. Now in these calculations, we've done daily rebalancing, and also it's scaled as if you'd invested $100 at the start of 2008. So this compares 65%, 55%, 45 and 35% US weightings, with the remainder distributed proportionally between developed markets ex-US and emerging markets. So at 65% US, there's 25% developed markets ex-US and 10% EM. Now what we see with the historic returns is that the higher the US weighting, the better the historical performance, especially since about 2015. The All Country World Index matches the 55% portfolio the closest. US weighting in an all-world fund has fluctuated between about 40 to 65% since 2008. However, if you believe that the US stock market will underperform those of the rest of the world in future, this portfolio allows you to dial down your US exposure. If your assumption's correct, that would result in outperformance relative to a market capitalization weighted index, like the MSCI ACWI index. It's very easy to construct a pie on Trading 212 to recreate a global index. If you want to tilt away from the market capitalization weightings, you just reduce the 65% in US stocks and then redistribute that weight between the 2 other regions, while keeping their relative weights the same. For example, a 10% underweight in the US would have 32% in developed ex-US and 13% in emerging market stocks. The risk of a US underweight is, of course, that the US continues to outperform and these gains are missed, or that the other components of the portfolio, so that would be developed ex-US and EM, underperform. Now, it may be the case that US growth continues for the next 5, 10, 20 years. It's impossible to accurately predict the future performance of global markets, but there are some important factors to consider that could help you frame your decision. These factors are general pointers and will change depending on the individual investor, their investment timeline, goals, preferences, and risk appetite. One thing to consider would be international trade and supply chains. We've seen the potentially damaging effects of US trade policy, and this has shaken the faith of investors in US exceptionalism and the ability of its stock market to consistently outperform. Another consideration would be politics and the policies around that. Global changes in governments and political outlooks can lead to dramatic changes in a country's fiscal and monetary policy. For example, changing corporation tax or income tax can change the bottom line for businesses and also for individuals, and cause businesses and individuals to relocate around the globe. Another question is around the future of the tech sector. Where will the global hub for tech be in a decade's time? Will it move towards Asia and away from the United States? Will AI continue to fuel excitement and investment? And which countries will innovate in this space? An often forgotten factor is the future of commodities. With shifting geopolitics and the risk of conflict, essential commodities such as oil, gas, and metals may see increases in demand and surging prices. Often it's the case that the most underdeveloped economies have large untapped mineral deposits and resources available, which could boost their stock markets relative to the US. US debt is a worry, and of course the US has a large amount of outstanding debt relative to its gross domestic product. While up to now US Treasuries have been seen as extremely safe, this may not be the case in future. If demand for US Treasuries wanes, higher funding costs would be a headwind for the US stock market. And then finally, there may be a realignment in the relative strength of currencies. Investing largely in the US stock market leads to unique risk linked to the US dollar. Whereas if we do invest globally, this would hedge that risk to some extent. And if faith in the strength of the US dollar as a safe haven currency erodes in the future, this may draw capital away from the United States. I hope that this has demonstrated a simple way to tilt your stock portfolio away from the United States. Now, it's probably not a good idea to make that tilt too large, as the US stock market remains dynamic and successful and is likely to carry on performing well into the future. But if you see greater opportunities in other regions, this approach lets you express those views in your portfolio. Please do like this video if you found it helpful, and remember to subscribe to Trading 212's channel so you don't miss out on future videos.